G'day, Internet. Max Wright here, and it's my pleasure to have on the show again Jeff Ross. Jeff, thanks for being here, buddy.
Thanks for having me, Max. I always love being on your show.
All right, good stuff. So we have Bitcoin pushing up against 25,000 here today. We had a good rally off the lows of what was it, 18,000 plus or minus a little bit. So is the bottom in? Is there more bottom to come? Give us your thoughts on where we're going.
Yeah, well, that's the loaded question that everybody wants to know, right? And so I will tell you that I started out as a skeptic because of my macro views that everything still looks very bearish. So first of all, my macro views, very bearish still. The data looks terrible. Small businesses are getting hammered right now, and their outlook is basically at historic lows right now. Consumer confidence still remains near historic lows. Inflation remains high. We'll get back to inflation. The yield curve remains deeply inverted, although it's getting a little bit less inverted over the last few days, which is interesting. The 2-year yield is still sitting at 3.18%, which tells me the Fed can raise the federal funds rate at least another 50 basis points at their next meeting, but that still remains to be seen. We have more data that will come in before that time. So what do I see? I think that a recession, like a serious recession, not just a technical recession like we had in Q1 and Q2 of this year, a serious recession, I think, is still on the horizon, and I think it's inevitable. That said, it's not imminent. So important words. Inevitable means I think it's for sure going to happen based on what the yield curve is telling us, but not necessarily imminent. Sometimes when the yield curve inverts, we don't see the recession actually happen for several months or quarters later. And then one other interesting data point that I have to give credit to Josh Steiner out of Hedgeye. He came up with this a few days ago. Once the federal funds finishes, once the Federal Reserve finishes raising the federal funds rate, and that may happen in August or it may happen in December, somewhere around there, based on what the yield curves show. It takes another 21 months or so for equities markets to actually bottom. So think about that. So that's almost a year and a half to 2 years later is when you actually see a bottom in equity prices. So what are the markets doing right now? I think this has room to run. I think that we're in phase 2 of 3 phases of a recession right now. So phase 1 is the inflation is getting away from us. Everybody's scared. Markets panic, equities drop, oil spikes. And that's what we had up until basically June-ish or so, looking at the data. And that was very similar to what happened back in late 2007 and early 2008. And then oil finally breaks, inflation peaks and starts to come down. We start to see disinflation. The markets get really excited because this inflation problem has been solved, basically. And so we have this tremendous relief rally. And I think that's what we're in right now. And I think it's a real rally, and I think it will last for quite a while. The last time it happened back then was kind of mid 2008, and we had a nice rally that lasted for about 4 to 5 months or so in equities. But then what happens is the market pivots from, okay, we're, relief that we're finished with inflation to, oh crap, here comes a serious recession. And I think a serious worldwide recession is still on the horizon. And when that happens, the floor drops out of risk assets. So I expect that at some point, this jubilation, this relief rally will end. And then we're going to go even lower in the equities markets than we were before. And I think it's going to last for quite a while. So that's my outlook for now. So I'm currently optimistic, but I'm on the shorter term, a little bit longer, kind of the quarterly looking out. I start to get more pessimistic as we get closer to the end of this year and into 2023.
Gotcha. And what are some of those on the longer term view? What are some of those key things you're looking at that are causing such pessimism?
Well, I mean, honestly, it's pretty nasty out there. So with the high interest rates, so bank lending is starting to really pull in. People are kind of maxing out their credit card, they're maxing out their credit lines. People just aren't buying stuff anymore. So a lot of the transfer payments that were done post-COVID and the year to follow, where the government was basically just putting money into people's bank accounts, they're not doing that anymore. And so people aren't flush with cash like they were before. So they're not spending quite as much. Small businesses and large businesses now are all sensing that. So they're having not only hiring freezes, but people are actually letting go. of their workforce. It didn't get a lot of attention, but I believe Amazon just fired 6% of their workforce, which is a pretty significant number. I think it was like 100,000 employees. That's a pretty big deal. You know, Shopify, all these other bigger companies, they are either freezing hiring or actually slashing their workforce. So we're going to see unemployment start to rise, and that's just another typical indicator. It's kind of a lagging indicator, but I think heading into the second half, we're going to start to see unemployment rise, and you're going to see the Fed talking about that less and less. So inflation, even though it's probably peaked and it's, you know, coming down just a tad, it may remain kind of sticky high for a while. The only way that I see inflation coming down dramatically, like down to 5 or 4 or 3% or something like that, is if we have a huge capitulation in the markets and the equity markets just drop and oil drops. And that'll be a tough time for everybody if that happens. But so I'm just kind of watching and waiting and looking at those kind of indicators at this time.
Gotcha. Are you paying attention to what's happening over in China in the Chinese real estate market? Is that on your radar at all?
Not really. I try to focus mostly on what I can understand. The reason why I focus very little on China is I don't trust their data very
Mhm.
much. I think they can kind of be very selective on what they want to present to the world. So I hear the rumblings about it. I don't pay a ton of attention to it, although I will say it makes sense. I was talking about this last week on another program, and you know they put a tremendous amount of commodities into construction, both residential and commercial construction, over the last decade. Just a crazy amount, like the world has never seen before. And they built these ghost cities that everybody was talking about. And there's all this real estate, but there's not enough demand for the huge amount of real estate that they have. So they have this gigantic surplus. So it just makes sense that at some point the supply demand curves are going to come back to haunt them, and prices are going to come way down, and there's going to be kind of some chaos. So I think that it's legitimate. I think the Chinese citizens are kind of sick of this problem that they have, and I think that's going to get worse before it gets better as well.
Yeah, I'm watching that a lot. I mean, there's a lot of things that can go wrong all over the world for lots of different reasons. But that one, I've been keeping my eye on that one. That one just looks like it's in all kinds of trouble. And
Hmm.
in fact, as soon as Evergrande defaulted, I made a video saying, guys, this can take 6 months, 12 months, 24 months to play out. But the contagion from those types of events, that just takes a long time, and that can destroy worldwide markets for sure. And real estate's typically one of the last ones to kind of show its hands as a capitulation too, which is kind of interesting. So yeah, just keeping my eye on all of those things because it's getting very, very concerning over there. Just
Hmm.
bank failures, real estate failures, real estate companies, all the things in one of the biggest real estate markets in the world. Um, let's talk a little bit more about interest rates. Do you're expecting more hikes? Do you think, and for how long? Kind of, do you think that'll last?
Yeah, so for to figure out what the Fed's going to do, to divine and read the tea leaves of the Fed's plan, I really look at the 2-year Treasury yield as my go-to. So the 2-year Treasury yield tends to act as a cap or a governor for how high the Fed can raise the federal funds rate. So right now that's sitting at, as we speak, at 3.2%. What that tells me, with the federal funds rate at currently at 2.5%, is at the next September meeting, they may do a 50 bips raise up to 3%. They may, depending on what the 2-year shows, maybe the 2-year will be a little higher, and they may do a 75 bips raise up to 3.25%. But the 2-year is the governor. It's the limit. So they can't really go above that. If they do, that's when everything breaks and things fall apart quickly. The credit markets just don't work when that happens. So I don't see them going above the 2-year yield. I do think that it will continue if as I suspect, if inflation remains sticky high, if the markets don't completely crash and burn over the next few months, I think that 2-year yield will continue to creep higher and give the Fed a little more room to continue raising rates. So I think that they may get up to as high as 3.5, maybe even close to 4%, possibly, before this is over. And then when they do, that's when the markets will finally break and tell them, okay, you've gone too far, you need to stop. They'll pivot at that point. They'll start turning dovish again. Rates will come back down again. We'll go through another cycle. So that's what I'm suspecting. Because of this rally that we have right now, which I believe has legs and it will last for probably a few months at least, I'm staying bullish on my risk asset positions for now. So like basically, Bitcoin, by the way, is right on the cusp of my system of turning bullish. So I'm just chomping at the bit, waiting for it to officially turn bullish. But a lot of Bitcoin miners have turned bullish. The Nasdaq turned bullish over a week ago. So I've been very long and very happy, and I expect that to continue again for several months, and we'll see what the Fed does in response.
And these are your tools that you've put in place to keep your emotions out of it, keep things
Yep.
on check. So when that Bitcoin flashes bullish for you, that gives you permission to jump in.
Yes, exactly. So yeah, it keeps my emotions out and keeps my opinions out of it, right? So I talk all the time about my macro views. I look at everything. All the stats that I read are still very ugly, but you know what? The markets pivot on ugliness, and like I said, I think we're switching from a fear of inflation decline that we just had. Now we've conquered inflation basically, so we're having this rally, and then it's going to be a fear of recession, and that's the real fear, and that's the scary part. That's where markets take a serious hit, where they can go down 40 or 50%. So I think that's still coming, but I don't think it will be for a while yet.
Gotcha. All right, let's pivot here because I appreciate the macro update. That's awesome. But you wrote something on Twitter not too long ago, and it really caught my eye. I wanted to talk about it a little bit. Your statement was, before the world-altering separation of money and state finally occurs, Bitcoin first needs to separate itself from crypto. Can you please elaborate on that a little bit?
Yeah, people get kind of annoyed with me because I talk about this all the time, but first of all, I think there's a distinct difference between what Bitcoin is and what basically the rest of the crypto universe is, and so that's important. And the reason why it's important is because until politicians and regulators figure this kind of stuff out, they need to tease out that these are two different entities and that's not all one and the same. And I get it, right? I know that they have similar features, right? They're blockchain based, they're cryptographically secure, those kind of things. I understand those similarities, but Bitcoin was literally created just to be better money for the world. It took all the problems of fiat and some of the great things about gold, and because we finally grew into this digital age, it could use these digital properties to create basically a perfect money. It's simple, it's elegant, it's decentralized, it's apolitical, it's totally secure. That's what Bitcoin is at its base layer. The rest of crypto to me is more like venture capital in real time, mark to market venture capital, kind of glued to a blockchain. It has they have their own technological use cases. I get it. I think some crypto has value. I think lots of it doesn't. I do think lots of it is full of scammers, but there is some real use cases for a lot of that. I think arts, entertainment, video games, just lots of random uses like that. They do have some kind of value, but they're different. They're basically tech platforms. They're basically proof of stake oriented. And I think there only needs to be one proof of work money. And there are many proof of work systems still left out there. But I think it will eventually kind of coalesce into just Bitcoin as the world's proof of work, apolitical, decentralized, secure money. So I think that's very important. And I think that as long as people keep mixing that up, and people do, everybody I talk to literally on a daily basis, if I bring up Bitcoin or if they bring up Bitcoin, they immediately transition into, well, what about Ethereum? What about Solana? What about Cardano? And all these kind of things. And I keep telling like, those are not the same things. They have completely different use cases. They have different goals. One is a multifunctional jack of all trades platform to do lots of different things. And one is just simply better money. So anyways, I think it's just very important to understand that. And I do think, by the way, that Gary Gensler gets it as the chair of the SEC, even though he still hasn't really done much about it. I think he views Bitcoin simply as commodity money, like neutral commodity money. That's it. And then he talks about these other things as being securities and just have, again, very different forms and functions.
Gotcha. Have you had a chance to think about what that process of separation looks like? Is it a legal thing? What do you think about?
I think it's all of that. I think it begins with education. People just need to understand the difference in their mind. And we're nowhere near that, by the way. I mean, we're years and years and years away from that, because even the people who are putting bills through in Congress and, people who are pro Bitcoin and also pro crypto, and that's fine to be pro both, but they keep glomming the two together as though they're the same thing. And I think they just need to be completely distinguished and treated completely separated. So I think it's a matter of education. And as the education and knowledge grows of what these two and what the purposes of each are, then they can make separate regulatory platforms for them. They can, different rules, things like that. It'll just be a much simpler world, but I think it's going to be sort of an ugly decade as we try to get through that educational process and make those two clear-cut paths for these assets.
Awesome. Thank you for taking the time to explain that.
Sure.
All right, Jeff, that's all I got for today. Thank you so much for joining us.
Thanks, Max. I appreciate you having me back on your show.
You're absolutely welcome. Guys, do me a favor, hit that like button, hit that subscribe button, and let me know in the comments below, do you think Jeff's assessment is correct? Does this rally have more legs, or are we going to turn around here at the 25K mark? Or is this not a relief rally at all? This is just the new bull market. Let me know in the comments below. Okay, guys, thanks so much, and I'll see you soon.